Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I am the tax director here at Quest Cooper. Today I've been joined by my colleague Mahar Afzal, and together we will be taking you through today's webinar. So the topic for today is qualifying distributors and how they can enjoy the 0% corporate tax rate under the UAE corporate tax law. So if you have missed any of our previous lectures, they're available on our YouTube channel. Our handle is Quest Cooper. Particularly if you were not here for last week's webinar, which was where we were discussing the tax on commodity traders, I would encourage you to go back and revisit it, because today we will be discussing the taxability on the distributors and then linking the same with the commodity traders. So if you have any questions after these webinars or today's webinar, you can always email us at info@questcooper.com and we will be happy to respond to you. So now let's move on to our topic of today. And like I said, that last week we were discussing the traders and the qualifying commodity traders, and we had discussed a similar slide in last week's lecture as well. So let me take you through a recap of this slide. So traders, who are traders? Traders are the people who are buying and selling goods. So typically these people, they buy goods from suppliers who might be based outside of UAE, so they might be importing the goods, or they might be buying from the local suppliers. And then without any value addition, they will keep a margin and then sell it at a higher price to customers who might be located in the free zones or outside the free zone. They can then be classified as exempt person, out of scope person, or taxable person. Now, exempt person, we had discussed in detail in last week's lecture that certain kind of people are exempt under the corporate tax law, like government entities, government control entities, entities involved in extractive business, entities involved in non-extractive natural resource business, qualifying free zone, qualifying public benefit entities, and so on. So they are out of scope persons, for example, like natural persons who are not doing any business or business activities in the UAE, or non-resident non-resident person who might not have a PE in the UAE, or they might not be earning any UAE source income or have an excess in the UAE. So if you can see that the non-resident person who do have a PE or they're earning UAE source income, they are part of the resident taxable traders. And those who don't have a PE or earning any UAE source income or have an excess in the UAE, they are out of scope person. So then under the taxable person, we already discussed the non-resident taxable traders. Now we have resident taxable traders as well. So they can further be classified as natural person, juridical person, and the natural person, like we discussed earlier, they are those where the owners and the company, they don't have any separate legal entity, they're one and the same, like sole proprietorship, freelancers, and then juridical person basically can be incorporated in the UAE, or they can be incorporated out of the UAE. They are resident person. If they are out of the UAE and they manage and controlled in the UAE, they would be termed as juridical person under the resident taxable person. And then those incorporated in the UAE can further be incorporated either in the free zone or they can be based out of the mainland. And in the free zone also, they might have a qualifying free zone person status or not, and they can be in the designated free zone or they could be outside the designated free zone. They could be dealing in qualifying commodities like we had discussed last week, and they could be selling to resellers or to end users or dealing in non-qualifying commodities. So we will be discussing all this in our later slide. So for free zone person, a free zone person who is dealing in any activity with another customer who is also based in the free zone. So they need to be sure that they are not they're not doing anything which is part of the excluded activities, and that that person is a beneficial recipient of that activity. Then they can generate qualifying income. But if their customers are outside of the free zone, then they need to be mindful that it has to be one of the activities which is given under the ministerial decision, which is in this slide. So this slide lays out 14 activities which are part of the qualifying activities, and they need to be doing one of these activities if they are dealing with any non-free zone person, and it can't be one of the excluded activities, for example, like transactions with natural person. So last week we were discussing trading of qualifying commodities. This week we are discussing distribution of goods and material. And why this I've laid down the slide is because later we will be linking both of them, and we will also be touching upon the ancillary activities, which also from any of the 13 activities, it can be part of that will also form the qualifying activities. So now distribution of goods and material, you can see that can be done from a designated zone. So all these different activities have different conditions. We discussed for trading of qualifying commodities that you need to be dealing in those commodities which are qualifying commodities, meaning they are traded on a recognized commodity exchange. They have to be in their raw form. So basically, all of these activities have different conditions which need to be met for it to be for you to have generate qualifying income from them. So we'll discuss in detail the distribution of goods and material in this lecture. So the UAE government, like I said, one of the activities in the list is the distribution of goods activity. So 0% corporate tax rate can be enjoyed by a distributor who is basically operating in a designated zone. Before that, they need to be a qualifying free zone person, meaning they need to be meeting all the conditions for a qualifying free zone person. What are those conditions? They need to maintain an adequate substance in the designated zone. They need to drive qualifying income. Like we said, that they can drive qualifying income from any person who is located in a free zone, as long as they are beneficial recipient, as long as it's not an excluded activity. They can drive qualifying income from non-free zone person, as long as it is one of those activities that we just discussed in the previous slides, and they're meeting all the conditions of those activities. They have another condition is that they have to elect not to be part of the standard corporate tax rules, meaning they cannot opt out of the qualifying free zone person status. They have to meet the de minimis criteria, which is that your qualifying income cannot be less than 5 million or 5% of total revenue, whichever is less. They need to have audited financial statements, and they need to adhere to transfer pricing regulations like arm's length principle and maintain the documentation under transfer pricing. So once all these conditions are met, then we will look at the first condition for this particular activity, which is that the distributor needs to be in a designated zone. So now what is a designated zone? Under the corporate tax law, they have defined designated zone as a designated zone is as defined in the Federal Decree Law number 8 of 2017 on value added tax, and its amendment at which has been included as a free zone for the purpose of corporate tax law. So there are two conditions to be met. One, it has to be in the list of the designated zone, which is under VAT, and it has to be included as a free zone for the purpose of corporate tax law. So now in the Federal Decree Law number 8, they have said that any area specified by cabinet decision issued at the suggestion of the minister as a designated zone for the purpose of this decree law, and that list of designated zone has come out through cabinet decision number 59 of 2017. So whoever is in this list of designated zone for VAT purpose will also be considered as a designated zone for corporate tax purpose as well. Now, what is the criteria for this designated zone? They have explained in the VAT law that a designated zone are the basic characteristic of a designated zone is this, that it has a custom procedure in place. They need to have security procedures. There is a restriction on the movement of the goods and the people, and it is a strict defined area basically. So if it is in that list of the designated zone that has been given for VAT, then it will be counted as a designated zone for corporate tax purpose as well. Now, the second condition, which is that it should also be a free zone in the list of the free zone as per corporate tax law. Now, this list has not come out yet. So at the moment, all the free zones are considered as a free zone for corporate tax purpose. It could be later that a separate list comes out where the list of free zone does not include all the free zone. But I think it is highly unlikely that one of the designated zone on the list of the VAT designated zone would not be part of the free zone. But for discussion argument's sake, if there is a designated zone in the VAT list and it is not part of the free zone in the CT list, then it's not meeting both the conditions. But that's highly unlikely because we think that all of the designated zone in the VAT list would be part of the free zone list. Might be that certain free zones are excluded, but all designated zones would most probably be part of this. And the guide that had come out for free zone, it had further clarified that if you're having any confusion, if you don't know that you're in a designated zone or in a free zone, so if you are not able to judge this criteria, then you have to check with your respective free zone authority to confirm if they are operating in a free zone or a designated zone. Now, this is the list that had come out, the cabinet decision number 59 of 2017. It has specifically, in terms of different emirates, given a conclusive list that these are the designated zone. So if you notice two things, one, that some of these designated zone have a expiry date, So you have to be careful of that. You're not following the list blindly. If any amendment comes and there is an expiry date to that designated zone, then it will not be considered a designated zone after that point. So if you can see in the Dubai list, there are 2 designated zones which no longer are designated zone at this time. Now, further, if you have any confusion, like we have clients who had confusion for, let's say, Ras Al Khaimah Economic Zone. So they're based in Ras Al Khaimah Economic Zone. They don't know if it's a designated zone or it is free zone. Now there are different part of Rakesh. There is a business zone as well and also industrial zone. So if you see the list for Ras Al Khaimah, you can see that specifically the industrial zone are mentioned separately, like Al Hamra Industrial Zone, Al Kahel Industrial Zone, Al Hulala Industrial Zone. These are part of Rakesh, but these are the industrial zone. The business zone is not mentioned here. So that will not be considered as designated zone. It's not also meeting the general criteria given in the VAT law. It's not a confined area, not ruled by the custom or seen by them or for security purpose, and has no restriction. So, but if you have any confusion, the law has cleared. You need to go to the free zone authority and check with them if they fall under the designated zone or they fall under the free zone. So this onus has been given to the taxpayer that they need to clarify. So now we have seen 2 conditions. First, you need to be a qualifying free zone person. You need to be in the designated zone for this particular activity, which is for the distribution activity. So what is a distribution activity? Let's discuss that. So now distribution typically includes processing of transporting products from a manufacturer, storing them and selling them to different stores and customers. The key feature for this is that the distributor is not only transporting these products or storing them or selling them, they are also hold the title to the product. For example, in logistics, they are also moving the goods from point A to point B or storing them and then making it available to the customers, but they do not hold title of those goods. So for distribution, the key feature is that they need to be owner of those goods. They need to buy those goods first and then sell them. So the distribution of goods or material, they can be purchasing and selling of intangible goods, material component parts. It could be function like importing the goods, storing them, managing the inventory for them, handling, transporting, and exporting them to customers who may further resell, process, or modify them for sale. So now I've highlighted 2 parts here, which are important. We will be discussing in the later slide. First, it needs to be purchasing and selling of the tangible goods. And later, the customers need to be those who are further reselling it or processing or modifying them for resale. So distribution activity, it will qualify for 0% corporate tax exemption if first they are conducted in and from the designated zone, like we discussed what are designated zone. And then if those goods are entering the UAE, so we are talking about the foreign goods which are entering UAE. So for them, if they are, they have to be imported through the designated zone. So if they are not entering the UAE, for example, in the case of third port sales, high seas sales, where the goods do not enter UAE and they move from country A, where the supplier is, to country B, where the customer is, they do not enter UAE. So for that, this condition is not there that they don't need to enter UAE for it to be treated as qualifying, income or qualifying activity. But for those that are entering the UAE and they are imported goods, they need to be imported through the designated zone. Now, like we said before, that we had highlighted tangible products. So there is no restriction on the method of the distribution, but the product needs to be tangible products. Intangible products, which include services like license, products and services like license, software, financial products or services, they are not covered under distribution of goods. The only exclusion is, and where they will be treated as part of the goods, is if they are they integrated software or firmware where the income cannot be distinctively identified. If they fall under the definition of the goods to be part of the goods, then they will be part of this distribution of goods activity. Otherwise, they will not. The second thing we discussed before in the earlier slide is the type of customer, which is important, which we had highlighted. That the other condition to meet, now you're a qualifying free zone person, you're in the designated zone, you are doing the activity of distribution. Now, who are you distributing to? So those there they have clarified that those type of customer need to be those who are reselling the goods. They cannot be end users of the goods. So they have to be provided to a customer who either resells the goods as it is or they're processing them for resale for it to be a qualifying activity. If they are the end users, meaning they are the individual who are using or consuming the goods, then it will not meet the criteria for qualifying activity. Now, end user is the individual who ultimately utilizes the product for its intended purpose, whether it is personal, commercial, or industrial. So as long as they have utilized the product, consumed the product, they will be called end users. So for example, let's take that cutting machine. So if somebody is selling cutting machine to a customer, that customer, as it is taking the cutting machine and sending and selling it to end users. So they are not the end users, they are the resellers. If they are using the cutting machine for their own purpose, meaning they are cutting their raw material, making clothes. So that means they are the end users, they're using those goods. They might be processing them, meaning maybe they take the cutting machine, they might, paint it, might reband it, put their logo on it, might add a, tray on it, and then they resell it. So they're still not using it, they're still not the end users, they are reselling them. So if they are doing that, then only it will be a qualifying activity. If they're using it themselves, so then they will not be, then it will not be a qualifying activity. Now, how you will know that they are end users or resellers? This you need to ensure either you will take a confirmation from them, either it will be written in the agreement that they cannot use this, they need to resell it. You have to do your due diligence, you have to do your know your customer procedures. So this onus is on you. You need to, the taxpayer, the taxable person need to verify that the customer is not the end user. So the FT has put this onus on the distributor and not on the customer. So we need to make sure that if you are supplying to the end users, it has to be below the de minimis threshold, or you have to make sure that you are not supplying to end users. Now, this distribution activity under the free zone guide, they have tried to clarify that what kind of activity will be part of this distribution activity. So first is the purchase and resale of goods and material. Like we said, that we buy product at a lower cost, we put our margin and we sell it to our customer. So that is the main activity which is under the distribution. Now, if you are storing that product before delivering it to the customer after buying it from the manufacturer, that will also be included. Transporting it to the customer from the warehouse or from the origin destination from the manufacturer, that will also be included. If you're doing the inventory management, like tracking the stocks levels of the orders, sales and deliveries, that will also be part of the distribution activity. If you're processing the order, receiving the order, then processing it and arranging the delivery for it, that will be part of the distribution activity as well. Packaging and repackaging, if you're adding your branding or any instructions or warranty information, this will also be part of the distribution activity. So this is not an exhaustive list. This is what the guideline has been given. This is what is included in that, but this is the broad guideline which needs to be followed. So like we discussed in the first slide, that there are those 13 activities which are qualifying activities. And then they said that any activity which is ancillary to those activities will also be considered as generating qualifying income. So what are ancillary activities? Those are those that are necessary for the performance of the main activity. That means the main activity cannot be performed without that activity. And it makes a very minor contribution to the main activity in terms of revenue, generating the revenue, but is so closely related to the main activity that it cannot be seen as a separate activity. So some of the example of the ancillary activities for distribution of goods or materials, like marketing and advertising, that a company distributor could do to help promote the products and drive the sale volume, or quality control inspection before they're delivering the goods to a customer. They might be inspecting it to check the quality, of the goods, or any customer support services like handling any queries, grievances, any feedback from the resellers. So these activities would be ancillary activities for the distribution of goods. And these activities are not considered as a qualifying activity on a standalone basis. That means that you need to be performing the main activities and these activities with them. You cannot only be doing these activities and then consider them to be qualifying activities. So you need to be in the distribution business first and then doing these ancillary activities together with that for it to be considered as qualifying activity. So now I'll hand it over to Mahar, who will take you through the slides.
Hello, Faiza. Thank you very much. Thank you very much for giving very detailed presentation on the distribution of business or distribution activities from the designated zone. So what is the core objective of our webinar? As further discuss, whatever we are discussing today, we are discussing traders, distributors. What is the difference in between the trading activity? What is the difference of application of corporate tax on the distribution activities? But then we'll go through the examples as well. So whatever we have already discussed for the traders, we have already established that the businesses can be exempt persons, it can be out of the scope persons. It can be taxable person, it can be a resident taxable person, non-resident taxable person, then it can be a natural person, juridical person. Then we discuss juridical persons are the incorporated in the UAE in or might be on the mainland in the free zone. In the free zone, then we established in a previous webinar, it can be a qualifying free zone person. If the qualifying free zone person is dealing with the trading of the qualifying commodities with the non-free zone person, their income will be qualifying income as well. Moreover, we established that if this is a natural person is based within the designated zone, either as a qualifying free zone persons or non-qualifying free zone person, or the natural person who is based on the mainland, the tax treatment for the natural person is same. There is no difference. As we know, up to 1 million, they are not liable to register. 1 to 3 million, they can opt for the small business relief. More than 3 million, the taxation is 0%. Up to 375,000. More than 375,000, tax is 9%. Then in that, when someone is working as a trader, if the qualifying free zone person is a trader, then we discuss that if the trader who is a qualifying free zone person and the person is dealing with the other free zone person, and other free zone person are the ultimate beneficial recipient of the goods, then it will be considered qualifying activity. It will generate qualifying income. Otherwise, it will generate non-qualifying income if they are the not ultimate beneficial recipient. Then we discuss if the traders are dealing with the non-free zone person, if the goods are non-qualifying commodity, then it will be considered non-qualifying income. Then we discuss if the traders are the qualifying free zone person, and they are dealing with the non-free zone persons and they are selling them qualifying commodities, then it will be considered their qualifying income. So what are the qualifying commodities? We established the qualifying commodities are metals, MEA, metals, minerals, energy and agriculture commodity. The minor processing, they are being sold in the raw form, they are being sold to the recognized stock exchanges. The physical trading of the commodity, the bought and sold to recognized stock exchanges. Then we say recognized stock exchanges are commodity stock exchanges established in the UAE under the supervisory respective supervisory authority, and the supervisory authorities are financial services regulatory authority or any other commodity stock exchange that is established out of the UAE, but as per the equivalent status. This we have decided, concluded in our previous webinar for the trader, and one important qualifying activity was buying and selling of the goods. There was only one qualifying activity and other ancillary activities. As further discussed, distributors. What are the distributors? There is a possibility that the one person who is working as a trader, they are buying, selling the goods. The distributor, they are buying the goods, storing it and selling it. Objective ultimately, they are buying the goods and selling it. Distributor is buying the goods and selling it. Traders are buying the goods and selling it. One few extra things are there that the distributor, they are storing the goods. This is the qualifying activity. Along with it, they are providing the possibility that they are providing the transportation as well. So for the distributor, what we have concluded, just Faiza has concluded in the presentation that the distributor can be on the mainland or it can be in the free zone as well. If the distributors are on the free zone, they are buying and selling the goods, they will not be able to enjoy the qualifying free zone person's relief. Their income will be subject to tax. Up to 375,000 taxable income, they will, in case they are the natural person treatment, again, it will be same. It doesn't matter, you are the trader, you are the distributor, you are in the mainland, you are in the free zone. you are a qualifying free zone. A natural person cannot become a qualifying free zone. So natural person treatment is same if you are on the mainland, you are in the free zone. It doesn't matter, you are trader, you are distributor. Coming back to the juridical person. Now the juridical person, if they are based on the designated zone, we know this, they are liable to register up to 375,000. They will be liable to pay 0% corporate tax on the taxable income of 375,000. Any income more than that, that will be subject to tax at 9%. If these are the distributor, if they are based on the mainland, if the same distributor is in the free zone, there is a possibility that they are the qualifying free zone person. There is a possibility they are not the qualifying free zone person. Moreover, if they are the qualifying free zone person, might be they are based in the designated zone. So I can ask them, they are the qualifying free zone designated zone person. There is a possibility they are not the qualifying free zone designated zone person. The treatment is slightly different. Now, if the distributor are based within the qualifying free zone, either you are a trader, either you are a distributor, in both of the cases, treatment is same. The reason is basically traders are buying and selling the goods. Yes, distributors are buying and selling the goods. If they are not based, they both are qualifying free zone person, just keep in mind, but they both are not based in the designated zone. So if they are based in the, if they are based, I draw this comparison as well. If they are based within the free zone and both are the qualifying free zone person, so important thing is we need to look under this, are they dealing with the qualifying commodities with the non-free zone person? If they are dealing with the qualifying commodities with the non-free zone person, they will be generating qualifying income. Other than this, any income generated from the non-free zone person, it will be subject to tax. It will be non-qualifying income. In the same way, if the traders, if the distributor, both based in the free zone, they are the qualifying free zone person, but they are not based within the designated zone. Then in this situation, if they are selling any commodity to the free zone person who is the ultimate beneficial recipient of the commodity, their income will be considered qualifying income. So what I'm trying to say, basically, if the traders and if the distributor, they are based on the mainland, treatment will be same. It doesn't matter, you are a trader, you are a distributor. Up to 375,000, you will be paying 0% corporate tax. Beyond that, your income will be subject to tax at 9%. In the same way for the distributor as well, the same treatment. Now the second category is, you are performing activities from the free zone. You are performing activities from the free zone, but not from the designated zone. Now you are a qualifying free zone person or you are not a qualifying free zone person. You both are based within the free zone. In both of the cases, if you are a qualifying free zone person, your qualifying income will be 0 rated, non-qualifying 9%. Both of the treatment for the traders and distributor. And if you are in the free zone, you are not a qualifying free zone person, then the treatment will be exactly same like given in one. So possibility, what is the possibility? If you are based within the free zone, there is a possibility you are a qualifying free zone person. There is a possibility that you are not a qualifying free zone person. If you are not a qualifying free zone person, treatment will be same as given in one here. If you are a qualifying free zone person, now the question arises, either you based within a designated zone or out of the designated zone. You are a qualifying free zone person. If being a qualifying free zone person, you are based within the free zone but not in the designated zone. Now qualifying income 0%, non-qualifying 9%. And this treatment is same for both of the cases. Either you are a trader, either you are a distributor. So treatment is same if you are a trader, if you are a distributor, if you are based on the mainland, treatment is same. If you are in the free zone and you are not a qualifying free zone person, treatment is same for both of the cases. If you are in the free zone, you are a qualifying free zone person but not based within the designated zone, treatment is same. For these three cases, treatment is same. Now where is the difference? The difference is, if the distributor is based within the qualifying free zone designated zone. If the distributor, now if they are based within the qualifying free zone designated zone, now it depends. Are you selling to other free zone person, treatment will be same. If you are based within the qualifying free zone designated zone and designated zone, what are the designated zone we have just discussed? So if they are based in the qualifying free zone, designated zone, they are selling to free zone person, treatment is same. Because any sales to the free zone person, qualifying free zone person, any sales by the qualifying free zone person to the free zone persons who are the ultimate beneficial recipient, they will be considered qualifying income. So treatment will be same. Treatment will be same. Criteria is same. It will be considered qualifying income. Now, if they are dealing with the non-free zone person, keep in mind they are based within the designated zone. They are based within the designated zone. From the designated zone, they are selling qualifying commodities. Distributor is selling qualifying commodities. Trader is selling qualifying commodities. And both are based within the designated zone. Just look into the example. Both of the parties, party A is a trader, party B is a distributor. A and B both are within the JAFZA. JAFZA is a designated zone. From the JAFZA, both of the parties, one is buying and selling the goods, and party B is buying the goods, storing, providing transport. They are acting as a distributor. If both of the parties are within the designated zone, they are the qualifying free zone person. They are selling qualifying commodities, MMEA, minerals, metals, energy, and what is the fourth one? MMEA and agricultural commodities. If they are dealing these four commodities through the stock exchange, whatever the criteria is, all these criteria, I'm assuming this is being met. Then if this criteria is being met, their income will be considered qualifying income. You will be thinking distributor will be qualifying income. They are buying and selling, because this qualifying income is not based upon the distribution. This qualifying income is based upon the trading, because they are dealing with the qualifying commodities, MMEA. These are the gross products. These are being sold unprocessed in its original format, that are being traded on the recognized stock exchange. So these are the qualifying commodities, and these commodities are generating qualifying income based upon the qualifying activities of the trader, not based upon the distributor. Keep in mind. Now, there another scenario that they are based in the designated zone. In the JAFZA, A and B both are in the JAFZA. JAFZA is a qualifying free zone person, and this is the JAFZA is a qualifying free zone designated zone. Inside the JAFZA, there are two parties. One is the trader, one is the distributor, and both have the qualifying free zone persons. So now they are not dealing with the qualifying commodity, MMEA. They are dealing any other product other than these four products. So four categories. These they are dealing with the non-qualifying commodities. Now the question arises for the traders. If the trader is based in JAFZA, trader is buying and selling the goods which are not qualifying commodities, not being traded on the stock exchange, not being sold in the raw form. So means trader will be generating non-qualifying income, because this trader is not meeting the criteria, because trader can generate qualifying income only from the qualifying commodities. And these are the non-qualifying commodities, so it will be considered non-qualifying income. Now, if this trader, this or a distributor is based within the JAFZA, now the question arises, this distributor is selling the non-qualifying commodities to the end user or to the reseller. If this distributor based within the JAFZA, which is a qualifying free zone designated zone, person is a qualifying free zone person based within the designated zone, but they are selling the goods to the end user, not to the reseller, it means this income will be considered non-qualifying income. What is the reason behind this? Reason is, this is the one of the basic criteria for the reseller. They must be selling the, for the distributor, they must be selling the goods to the reseller. So if now two parties within a designated zone, JAFZA, both are the qualifying free zone persons. Now they are dealing with the non-qualifying commodities. If they are dealing with the non-qualifying commodities and the goods are being sold to the reseller, then distributor income will be considered qualifying income and trader income will be considered non-qualifying income. This, if you're looking into the criteria is different, and outcome is different as well. Here, if you're looking into this, criteria is different, outcome is same. So just this is the basically example what if they're basically what the difference, where the differences arise in case of trader and in case of distributor. You will be thinking might be one person is based within the JAFZA, he is a trader, he is buying and selling the goods. It should be considered qualifying income. Yes, it can be considered, but they need to maintain the qualifying activities. For the trading business, it has been given in the guide that their qualifying activities only buying and selling of the goods. This is not their qualifying activities for the trader. But for the distributor, these are the qualifying activities. What are the qualifying activities? Yes, warehousing. Distributor must be providing warehousing. Distributor must be providing transportation, delivery, and logistics wherever this is applicable. They will be providing inventory management, order processing, package and repackaging. These all are the qualifying activities for the distributor. But these are not the qualifying activity for the trader. Trader qualifying activity is buying and selling the goods, nothing more than this. Now, the another difference, basically qualifying free zone person. What is the qualifying free zone person? There are 6 criteria for the qualifying free zone person. The basic criteria, they must be a free zone person. Free zone person means they are the juridical person, registered and incorporated within the free zone. This, if the business are registered and incorporated within the free zone, they are the juridical person. They, by default, they will be considered qualifying free zone person. And if they are in the designated zone, by default, they need to consider qualifying free zone designated zone person. Yes. Now, this is the 6 criteria: maintaining adequate substance, comply TP policies and procedures, have audited financial statement, not opted to be subject to tax, de minimis criteria, they need to meet it. So this 5 criteria is same for both of the parties. Now, the only difference is this trader can be based out of the designated zone as well. They need to maintain the adequate substance within the free zone. But for the qualifying free zone distributor, law requires the need to maintain the substance within the designated zone where. So basically, this is the major difference. Rest everything is same. So I believe we know now what is the basically traders, when they can generate qualifying income, when they can generate non-qualifying income, when can we apply 0% tax, 9% tax. The same thing is applicable for the distributor as well. Now we have a thorough understanding about the distributor, trader and distributor. And distributor, important thing, law requires basically buying and selling the goods from the free zone. The important thing is, if the goods are being bought and sold out of the free zone and goods are not entering into the UAE, it has been given in the guide, still it will be generating qualifying income. If the goods are entering into the UAE, suppose goods are being bought from China, and these goods are being jobs are based entity, as we discussed, A and B, both of the parties based within the designated zone. A is a trader, B is a distributor. So if B is buying and selling the goods from the designated zone, he is based in the designated zone, assume they are buying the goods from China and selling these goods to Africa. If the goods, they are performing all qualifying activities like buying and selling of the goods, warehousing in this case, it will not be applicable, transportation, delivery, logistic, import, inventory management, order processing, packing, repacking, wherever these activities are applicable, they are buying the goods from China, selling it to any country in Africa. Even the goods are not entering into the UAE state, it will be considered qualifying activity of the distributor. It will be generating qualifying income. So in the same way, if the goods are being bought from China, these goods are entering into the UAE, then law required, if the goods are being entered into the UAE, this is compulsory for the distributor. They need to bring the import or bring or import the goods through the designated zone within the UAE. Then it will be considered qualifying income. In the same way, if the goods are being exported by the distributor who is based within the designated zone, then they say the routing of the goods through the designated zone is not required as per the law. We'll go through the examples as well. So natural person, as we discussed, is the same treatment. Even you are a distributor, even you are a trader, you are a free zone based natural person or mainland based natural person, treatment is same. Juridical person, we have already discussed the treatment. For the juridical person, the non-resident treatment is same. The non-resident up to non-resident person, P of the non-resident, any income attributable to the P, it will be up to 375,000, 0%, other than this 9%. UAE source income, 0% withholding tax. Now, these are the examples that I was supposed to discuss. These are the distribution business. If you can see here, this example we have taken from the guide provided by the FTA, published by the FTA. You can see these are the manufacturer. This is the basically a retailer or distributor, end user. This is not the end user. This manufacturer, this party, this company C, GC based within a designated zone. Assuming Jafza, C is based in the Jafza, but they are buying the goods from China country A, that's selling the goods to Africa country B, South Africa. So goods are moving from China to Africa. If the goods are moving from China to Africa, and this company B is based within the Jafza, which is the designated zone, then as per the guide, income will be considered qualifying income. It will generate 0% corporate tax provided all other conditions are being met. Important condition is de minimis. So they need to be performing all qualifying activities like transportation, warehouse. In this case, this is not applicable. Buying and selling of the goods, marketing of the goods. All these things are being managed from the designated zone. And the important thing is they are maintaining the adequate substance within the designated zone. For example, we have taken jobs. They need to maintain the adequate substance within the designated zone as well. So there is no possibility like this is jobs entity, this is a qualifying free zone commodity. This is assuming DMCC. DMCC, as per our understanding, this is not a designated zone. So if they have an office here, staff is based here, substance is being maintained here, but they are designated zone company, then it will be assumed that the company has not met the adequate substance condition. So income will not be, they will not be considered a qualifying free zone designated zone person. This is another example given in the guide. In this example, you can look into this. This is the company E, designated zone person, assuming again the company is based within the JAFZA. From the JAFZA, this is a manufacturer, importer, UAE manufacturer. From the UAE manufacturer, they are exporting the goods to country A, retailer, distributor. They are not selling to the end user. So they are based within the JAFZA. Goods are moving out of the free zone. Their goods are not moving through the designated zone. So if the goods are being exported from the UAE and the person who is exporting the goods, they are based within the designated zone, but the goods are being exported even from the non-designated zone, still it will generate qualifying income. You can go through this. This is the outcome. A company conducts its activities in or from a designated zone. Yes, from the JAFZA, and goods are being already in the UAE. Yes. Okay, E purchase them, they do not need to pass through the designated zone. So E is considered to be performing qualifying activities, and this income from generated from this activity will be considered qualifying income. In the same way, one more example is there. This example we have taken from the guide as well. Just look into this. This is a company F. Another company, assuming this company is based in the designated zone, and for discussion purposes, we can say this company is also based within the designated zone, assuming JAFZA. Now, manufacturer or importer, this manufacturer imported in the UAE, end user, no, sorry, reseller is in the UAE. This is not the end user. Goods are moving from Dubai to Abu Dhabi to Dubai. These all activities are being performed from the designated zone. Law says it will be considered qualifying activity because all conditions are being met. Distributor versus agent. If someone is acting as an agent, agent will be providing the services. Agent will not be buying and selling the goods. Agent will be providing the services. So these services, which will not be considered qualifying activity, specifically related to that, it will not be considered distribution business. We need to look into the other activities. Might be they will be considered as a qualifying activity. At least it will not be considered distribution business, because the distribution business requires that the person who is distributor, they need to take the ownership of the goods. An agent will not be taking the ownership of the goods. They will be acting as a middleman. Might be they will be supporting to lock the deal, and after this they will be helping to deliver the goods. At the end, they will be not be taking the ownership of the goods. If someone is working as if someone is working as a sales agent, it will not be considered as a distribution business. The same thing has been given in the guide as well. Just look into this example. This example is specifically for this distribution versus sales agent. A book, this example we have taken from the guide as well. A book publishing company is in the mainland UAE, has published a new novel. It sells the novel in bulk to the distributor. Company D, a free zone person in designated zone. D is in the designated zone. A book publishing company is in the mainland. Company D sells the books to different bookstores across the UAE and outside UAE through the designated zone. It means D is in the designated zone. D owns the books. Important thing means D is not acting as an agent. D is not acting as a sales agent. D is acting as a distributor. D is buying the goods, taking the ownership of the goods. Then the D is selling the goods. Once it buys from them, publisher, it manages the logistic. They are managing the logistic. What is one of the primary qualifying activity? The books to the various bookstore. It also bear the financial risk. It looks, company D is performing the qualifying activity because D is based within a designated zone. D is buying the books. D is taking the ownership of the books. D is managing the logistic. D is selling the goods. It means D is performing the qualifying activity. D is buying the goods from the mainland. So even they are selling within the UAE, even they are selling out of the UAE, and the movement of the goods through the designated zone is not required as given in the law. This is the same book publishing company also employs a sales agent. Now the company which is in the UAE mainland, this company is employing a sales agent, company S. S is a free zone person in designated zone to sell to his books. S doesn't buy the books. Means S is not meeting one of the very primary conditions for the distribution business. S is not taking the ownership of the goods. Instead, it represents the publishing company to get bookstore to place order for the books, which is then supplied directly by the publishers. Publisher S is acting as a middleman, finding market for them, engaging customer for them, bringing customer, then asking S. Okay, then asking the publishing company. S is asking the publishing company to distribute the goods directly to the customer without S is not taking the ownership. Company has performed all its marketing and promotion activities from the designated zone. It gets the commission for each book ordered due to their efforts. Okay. Company S doesn't own the books to bear the financial risk. If the books doesn't sell, it's not primary role is to facilitate the sale, nothing more than this. The activities of company S do not involve the qualifying activity of the distribution of goods. It doesn't take a title of the books. Company S render professional services for sales and marketing. As I discussed, they are just giving services, nothing more than this. Agency services, referral services. They are not buying and selling the goods. So it will not be considered qualifying activity, at least under the distribution businesses. We need to explore the other activities. There is a possibility might be this is a qualifying activity in any other category, but at least this is not a distribution business. This is over from my side. Thank you very much. We can quickly go through the guide as well that were discussed earlier. Let me go through the guide quickly. Distribution. I think we have gone through this. Typically involve the process of transportation of the goods. Distribution different for logistics services. This is same as in and from the designated zone may include. These are the basically qualifying activities. Reseller, these are being useful to the reseller. The no limitation on the mode of distribution. Any mode you can adopt. If the embedded software further has already discussed, you are not selling the goods to the end user, but you are selling to the reseller. You can look into this. If the goods are being reseller, then you are in the distribution business. Otherwise, you are not in the distribution businesses. Then they are given the qualifying activities. So this is important. How do you know that your customer is a reseller or not? Law says you need to take confirmation from them. You need to perform the KYC. That is engage in the activity of distribution of goods. You need to perform the KYC. In the same qualifying activities, these are the qualifying activities. Activities that might be treated as ancillary activities. These are the two ancillary activities. This example we have already discussed. This example we have already discussed as well when the goods are moving from the country UAE to the reseller anywhere across the globe. This example we have discussed as well when the goods are moving from UAE to country A. Here the goods are moving from country A to UAE. It needs to come through the designated zone. If the goods are coming out of the UAE in the UAE, then the goods needs to come through the designated zone. If the goods are moving from UAE to any other country out of the UAE, then the movement of the goods through the designated zone is not required. And if the goods are moving from UAE to UAE, if the goods are moving UAE to UAE, in this situation, they said there's no movement, the requirement is not through the designated zone. So this is the example that we have already discussed. This example we have not discussed. if the goods are being imported, but I quoted this in my example that if the goods are coming in the UAE, then goods needs to come through the designated zone. You can look into the example. This is a designated zone person D based in the designated zone, buying the goods from any country. If they are buying the goods from any country, then this country A, and then goods are coming from here in the designated zone. From the designated zone, these goods are coming on the UAE mainland, which is to a reseller, which was not to the end user. Sales agent, this example, we a book publishing company we have discussed as well. So this is over from my side, this is over from our side. And if you have any question, you can ask. Okay, guys, thank you very much. Thank you very much, Faiza.
Thank you, everyone.
Thank you very much and have a lovely evening to everyone. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.